This is retail bankruptcies. I love this. Check it. It's got, your columns are the number of retail bankruptcies you've had in any one year back to 2000. We've had some incredible years, 04, 05. Lo and behold, nobody went bankrupt. Why? It was a great economy. We had 08, 09, huge tick up. Why? I think everybody knows why. Since 09, let's look at 10, 11, 12, 13, 14, 15. We had 6 years in a row where we had a decline in overall bankruptcies in retail compared to the peak that we previously set in 2009. Well, then come along 2016. It's that red bar there. We've already had more this year than we've had in any of the full years going back 6 years. It's only May. I'm telling you, we're going to see more bankruptcies. Slightly more of them happen in the first quarter of the year, but only 33%, I believe. So it's not grossly skewed towards first quarter. There absolutely will be more. If we keep this run rate, you're going to see that pink column there, which will just be a mess. Like Sears, which is very possible, Sears would really take it up. It counts as one, but as far as its sales base goes, it has a very material impact. And just as a frame of reference, if anybody cares, when you look at a bankruptcy in retail, usually they happen a lot later than everybody thinks. And the real reason why is because most of these companies are flush with cash. They've got pretty decent cash flow. They don't have any assets. I'm doing little quotes with my fingers now. They do have assets, which I'll hit on in a minute. And they can just kind of string it along for a while. And usually what will happen is a company will get really desperate towards the end of one economic cycle, and they find a way to stick it out through the next economic cycle. And at the end of that next economic cycle, it usually just ends very, very badly and they go under. So there's a couple of them on there, Sears and others.
Brian, just to echo what you're saying there, that chart looks about, it's probably not as drastic considering the pink chart is, that is this year to date versus, the other years, which are the other years in the entire years. But that's about what if you look at all of credit markets, all of bankruptcies, that's about what it looks like. Maybe consider that pink chart as year to date this year versus year to date in previous years. I mean, it's a cyclical picture, and that's what it looks like in most everything. I haven't actually updated that chart in a few weeks, but as of a few weeks ago, that's about what it looks like in credit markets as a whole.
You know what's interesting about that too, Ben, is that a lot of these companies in retail, like your Macy's and your Kohl's, et cetera, they've got big credit portfolios.
Yeah.
And so I'll tell you, for Kohl's now, credit income is about 30% of EBIT.
Really?
In the most recent quarter, credit income plus real estate gains accounted for 70% of Macy's EBIT.
Wow.
So these companies aren't earning a lot off their core operations anymore. They need credit, and yet we're starting to see charge-offs are really starting to tick up. They're admitting it to their credit. But I mean, not a good spot, especially when we've got multiples that are still kind of mid-cycle multiples on mid to upper cycle earnings.
Yeah, sure.
Not good.
Sure.